There are a couple of main stories I want to share with you today. First up, a couple of warning signs. First, the OECD report on Trump's tariffs and the Russell 2000 index. That's flashing some pretty serious warning signs. Also, this morning, the latest U.S. retail sales numbers are out. We're going to look at those, see what they have to say. First up, though, Trump's latest round of tariffs. And according to a new report from the Organization for Economic Cooperation and Development, the OECD, these tariffs definitely are slowing down economic growth. They're pushing prices higher. And yes, inflation seems to be creeping back in. So the gist of the report is, as we already know by now, Trump, of course, has slapped all these big import taxes, these tariffs, on a whole slew of goods. Countries like us here in Canada, Mexico, China, we haven't just sat back and taken this. We here in Canada, the other countries have retaliated with our own tariffs. But what's happening now is this back and forth is creating a ton of uncertainty out there for businesses. That means that they're holding off on new investments. Less investment, of course, means slower growth. And when growth slows, the economy starts to look a little bit shaky. I want to look at some of the numbers from this report here. The OECD now expects U.S. economic growth to slow to 2.2% in 2025 and drop even further to 1.6% in 2026. Headline inflation this year is expected to come in at 2.7% in the U.S., and it'll stick around as well. 2.5% is the forecast for 2026. In Canada, the report projects inflation of 2.6% this year and 2.5% in 2026. Now, from a GDP perspective, Canada's growth is expected to crawl at just 0.7% over the next couple of years. Mexico, even worse there, it's predicted to shrink by 1.3% this year and 0.6% in 2026. And those are big swings from the previous forecasts that were out, which were actually expecting growth. Now, I want to talk about Russell 2000. This is a stock index that tracks smaller U.S. companies. And historically, companies like this have been the proverbial canaries in the coal mine. When they struggle, it's often an early sign of trouble for the broader economy. Right now, the Russell isn't just struggling. The index is down around 20% from its peak, and that's almost double the drop of the S&P 500. It is basically in official bear market territory, which happens when an index drops 20% or more from its most recent highs. Now, it just hit that high now. We're going to have to see what happens over the next couple of months to confirm that. Just a quick blip doesn't necessarily confirm bear market. We'll have to wait and see what happens. So why does this really matter? Why am I focused on the Russell as opposed to the S&P 500? We like to watch both. But smaller companies, which the Russell represents, they don't have the deep pockets that these massive big corporations do, and they are more vulnerable to economic swings with the tariffs driving up costs, uncertainty slowing down business spending. These companies are really starting to feel the hit here. Another thing too, it's not just about the tariffs. We have other factors like government spending cuts, the federal workforce reductions. They're also adding pressure. And businesses are already warning about slowing consumer demand. We're going to see that in just a minute here, some rising prices and some tough times ahead. So when we look at what this means for the stock market, the Russell 2000 is kind of like a bit of an economic crystal ball. When it is struggling, historically, it often signals that the broader economy might be in trouble, and that's what has investors worried right now. When you look at the S&P 500, it's also dipped into correction territory. It's dropped around 10%, but the S&P 500 can be a little trickier. It is weighted more heavily in these giant tech companies. You think of Apple, Nvidia, all the companies we hear about on a daily basis. So when these stocks, start to wobble a little bit, the whole index feels it. They represent such a large chunk of the S&P 500. Now, some of the recent tech sell-off that we've seen could just be a reality check after we've seen the years of these super high valuations. Now, when I look at the broader worries, though, that's where the Russell 2000 is starting to sound an alarm. It's more focused on U.S. companies. The S&P 500 is more global. So that means that the Russell is giving us a clearer snapshot of what's happening right here in North America. And what I'm seeing isn't exactly reassuring. Now, where does this leave us as investors? Well, this is sort of where that OECD report comes in, combining these two different stories here. If the tariff tensions keep escalating, that could push the U.S. and the parts of the global economy closer to a recession. It's already warning that higher tariffs are going to slow growth. We've already seen those in the numbers, and it will also keep inflation higher than we'd like it to see. A higher inflation rate, that means that the Fed might just have to keep interest rates elevated longer than anyone wants, and that isn't a good thing for businesses or for consumers. Plus, with smaller companies already taking a hit, we could see pullbacks in hiring and spending that again would slow things down even more. So right now we're seeing a bit of a mixed bag out there. The data itself suggests that there are some real concerns about the economy. It's not all doom and gloom, at least not yet. The next few months are going to be crucial. Questions we'll have to watch for are, will businesses keep pulling back? Will the Fed have to be more aggressive with rate cuts? What are they going to do? Also, will some of these trade tensions ease? It might be sort of just time now to buckle up and stay cautious. We do cover the S&P 500, the NASDAQ, the TSX quite a bit on this channel, so I thought I'd just mention that watching the Russell 2000 could give some early clues as to where the broader market is heading. Now, also out this morning, the latest U.S. retail sales numbers are in for February, and there has been a little bit of a rebound, but it's not anywhere close really to the recovery that a lot of people were hoping for. Look at the numbers here. The sales rose 0.2% month over month. Not recovered from a really tough January, but it's still way below the 0.6% increase that a lot of economists had predicted. Let's take a look at what is behind the slowdown and what does it mean for the economy. First of all, the good news. We look at non-store retailers. So we think online shopping here, that led the pack, a solid 2.4% increase there. Health and personal care stores, they followed with a 1.7% gain. Then we see general merchandise, building supplies, that posted modest 0.2% gains. But we also saw several sectors that saw declines. We saw food services and drinking places. They took the hardest hit, dropping 1.5%. Gasoline service stations were down 1%. Clothing sales slipped 0.6%. And then we see some areas like furniture stores, sales there basically stalled out completely. Now, this is really where this report gets interesting. If we strip out the volatile categories, food services, auto dealers, building materials, gas stations, the numbers actually do look a little bit stronger. This is the core retail sales figure. That was actually up 1% in February. That's a pretty strong reversal from the 1% decline that we saw back in January. It also came in above the forecasted 0.2% rise. So while we are seeing the headline numbers look pretty weak, the underlying data say that the consumer spending might be holding up a little better than it first appears, at least in certain key sectors. These stronger core sales could be a positive sign for GDP growth in the first quarter. Now, overall, this too paints a bit of a mixed picture here. Yes, we do see that rebound, but it's softer than a lot of people would have liked to have seen. And with the declines in areas like dining, like clothing, it does raise questions about whether consumers are pulling back. And of course, we know how important consumer spending is to the overall economy. And that's what I have to ask, sort of, is this people tightening their belts? Is that going to be sticking around in response to the lingering economic pressures out there? That's the biggest question, I think, as we head into the next few months. Now, my suspicion here is that, yes, I do believe that customers are pulling back, and I think that that might last a little while. So what's the future outlook? Well, if core spending continues to show the strength, we could see some more positive momentum for GDP. But, and this is a big but here, if the more discretionary sectors, dining, clothing, if these keep sliding, that could be a signal of growing consumer caution. The next few months are going to be the key to understanding which way this trend is actually heading. Now, do you think that consumer spending is starting to crack? Let me know what your thoughts are in the comments. Now, also, if you found this breakdown helpful, don't forget to like, subscribe for more economic updates in future videos. That is all for today. If you do want to learn more about DIY investing, I will put a link for our Investing Academy in the description of this video. As always, thank you for watching, and we'll see you on Wednesday.